In the last video, we talked about stock market prices as if they are fully rational. We said, okay, well, a stock price is going to go up if the expected dividends go up, if the interest rates go down, if the risk premium goes down. All of those things are those are all rational explanations for why stock prices change. But the fact is that financial markets are not fully rational because they are inhabited by human beings, and human beings are very far from fully rational. And so one of the things that I think is important to remember, both in sort of regular economics but also in financial economics, is that there's a lot of irrationality going on. And so, behavioral economics has shown us a lot of ways that the market can deviate from full rationality, and one of those is definitely in asset prices. So if we think about asset prices, right? So an asset, remember, is anything you can own. That can include bonds, stocks, houses. There's some fundamental value. Now, what that fundamental value is can change, but it should be based on the stream of services that you are going to get from that asset, plus whatever you think it's going to be worth at the end of when you want to sell it. So a house, for example, provides you with housing. And the value that you should be willing to pay for a house should depend on what you would have to pay to rent a similar house, and then also what you think you'll be able to sell it for when you're ready to sell it. Similarly, we said the stock price is based on the dividends that you get while owning it and what you think you'll be able to sell it for when you're ready to sell it. So that's the fundamental value, right? That's what we've talked about so far. And a long-term investor, someone like Warren Buffett, goes around and looks for assets which he thinks are undervalued based on the fundamental value, with the theory that, okay, well, if I buy this now and I hold on to it, then I'm either going to make a bunch of money from the stream of payments, or other people are going to recognize that this is an undervalued asset and buy it, and the price will increase, and then I can sell it once it's not undervalued anymore. We get lots of bubbles in asset prices, and a bubble in an asset price is when the price goes above what we would think of as its fundamental value. And you could say in some ways that they are rational, right? So once you see a bubble start to increase, you have sort of two choices, right? You can say, all right, well, I'm not going to buy that because that's in a bubble. Or you can say, if I buy it now and the bubble keeps going up to a certain point, as long as I sell it before the bubble bursts, right? And bubbles always burst, I can make a lot of money. And so it could be a very rational thing to do to buy at the beginning of a bubble. And then, there can be fads, right? Fads can be, we've seen this recently with so-called meme stocks, where a certain stock will become popular, people will buy it, that will push it up above its fundamental value. That can, be just as much of an asset bubble as anything else, and then eventually we would expect it to fall back down. So there are bubbles in asset markets throughout history. So one of the first ones was a tulip bubble for tulip bulbs in the Netherlands in the 17th century. And they just started buying the tulip bulbs, and the idea was, oh, well, I could just buy them now, and then they keep going up. They keep being going up in value, and then I'll just sell it. So they have the price of one bulb went from 1,500 guineas in 1634 to 7,500 guineas in 1637. But eventually it collapsed. I mean, tulips are a great example. It's not like they're worthless, right? They provide flowers. Flowers are nice. But they don't provide, a stream of payments. So it's all about what it's going to be worth in the future. Eventually it collapsed, and of course a lot of people lost their money, which is always what happens when asset bubbles collapse. The other example here is a Russian financier created a company called MMM and promised these extraordinary returns of 3,000% a year. Even though it wasn't involved in any type of production and held no assets, its value increased from 1,600 rubles to 105,000 from February to July in 1994. This is basically a Ponzi scheme, right? So the interesting thing is, so a Ponzi scheme, if you're not aware, is basically where an investor, where someone promises these really high returns to investors and then, starts out with a small number of investors, it gets larger and larger and uses the more recent investors to pay off the earlier investors. And so it looks like they are really getting these returns. It's completely illegal now, of course, and eventually it collapses because of sort of the geometric growth that's required. Bernie Madoff is probably the most famous recent example of a Ponzi scheme. The interesting thing about asset bubbles is that they really are Ponzi schemes, but with no schemer, right? So they don't have anybody at the center that we can blame and say, oh, you are the person who's responsible for this tulip mania or for, the housing bubble. Whereas, of course, in this Russian example, there was someone to blame, although even so, people were, bidding up the prices there. So if we look at housing prices, it was pretty clear to a fair number of economists that, starting in sort of 2000, that we had sort of grown into a national bubble, right? Prices increased by about 50 to 60%, more in some areas, less in other areas. But there are always people who will argue during a bubble that, no, this is fundamental value. There's a change, and there's some reason that this asset is worth more and significantly more than it used to be. But as we see, the asset bubble did pop, and was basically back down to where it was. This is the price to rent ratio by 2012. Interestingly, housing prices are back up in a lot of places in the United States. One is because we once again have very low interest rates. Two is that in a lot of areas there are sort of severe restrictions on how much can be built. But then three, of course, is that, when prices are going up, people are more willing to buy and more willing to pay more because they expect that they'll be able to sell it if they need to. And that really is the definition of a bubble.